And welcome back to Good Morning Kenya. My name is Mike Mill. From politics now, we talk matters of agriculture, given that it's an economy that remains crucial to the country, and living its challenges unresolved is something we cannot afford. Now, according to the economic survey report of 2026, it indicates that agriculture, fisheries and forestry grew with about 2.8% in 2025. However, now when the rubber meets the road, production requires capital. Farmers need money for inputs, value addition, transport, and everything that pertains to agriculture, which is why we are talking about financing agriculture and why access to agriculture credit matters. And the question here is not even the existence of credits. It's about affordability, accessibility, and matters of appropriate structures available to the people responsible, as well as enterprises that need them most. And for that conversation, I'm joined by Christopher Kiburu, who is the Chief Credit Officer at Agricultural Finance Corporation. Welcome to Good Morning Kenya.
Thank you.
How are you doing this morning?
Fine, thank you.
Yes.
Yes.
Let's get into this conversation, and because, you know, when we talk about agriculture, it contributes a lot to the growth of the economy. And when you look at the Kenya's agricultural finance landscape, where's the problem? Where's the problem fundamentally? Because is it a shortage of money or just a shortage of appropriate structures and risk-adjusted finance?
Okay, thank you very much, Mike.
Karibu
I think that is a very good question to ask. Because when you look at agriculture sector, it is a sector that is quite important to this country. Agriculture contributes about 30% in GDP. And actually, it has employed almost 70% of the rural-based communities. And therefore, it is a sector that you cannot avoid. So to answer your question, I would say that agriculture needs a structured kind of financing. Why am I saying this? You look like agriculture faces quite a lot of issues. Number one is that agriculture is faced by the risk of absorbing climate shocks. And in fact, this is one thing that makes even the commercial banks try to avoid investing in agricultural sector, because there's floods, there is sometimes there is drought, and all these things affect the economic activities of the farmer. If there's drought, if there's floods, then it means if the farmers hand a credit facility, their crop or their livestock is going to fail. And once it fails, then it means that they'll be not able to observe their debt obligations as they fall due.
Yeah.
Number two is lack of concessional collateral. Many financial institutions want a collateral that can cover the risk. And many farmers, especially in the rural-based farmers, they lack these conventional collaterals. Also, agriculture needs what we call capital, patient capital. If you don't realign the credit facilities, the repayment with harvest cycles, then these farmers definitely will not be able to observe their debt obligation. And therefore, they need an atmosphere where, when they harvest, then they can always be able to pay their loans. So bullet payment lacks, especially in the commercial banking sector. And then also we have market volatility. And that is where, maybe, for example, where I work from, we have tried to find a way, because it is an DFI, to find a way on how then can we address the issue of market volatility. We've come up with very, very, very innovative ways to address this. One of them is what we call anchor client model. And this is where the DFI now, the FC, finances the large-scale farmers who then can aggregate and also can buy from the smallholder farmers, the underserved segment, their product, and therefore they create market in that scenario. We also have wholesale lending model, and this is where now we use intermediaries like SACCOs, microfinance institutions, to give credit facilities to the underserved sector. And when I talk of underserved, I mean the smallholder farmers, I mean the PWDs, that is persons living with disabilities. I mean also the rural-based micro enterprises, women, youth of this country, And therefore, if they could not afford to borrow from commercial sector, then we as TFIs come in to give those facilities to the SACCOs, to the MFIs, so that they can lend it to these farmers. So I would say that agricultural sector needs a structured kind of capital.
And how do we balance the development mandate with the need to remain financially sustainable and protect, public resources?
Oh, thank you. You see, one mandate of the development finance institutions is to de-risk the agricultural sector to unlock the private capital injections. So, for example, when you talk of de-risking, here we are talking of, wholesale lending, where we involve a SACCO and microfinance institutions. We are able also to leverage on their own capital. And when you leverage on their capital, what it means is that you are growing the portfolio of the agricultural lending. We are creating that credit accessibility. And by doing that, we are trying to impact the smallholder farmer who otherwise would not have gotten a loan facility. So in terms of taking care of the public funds, this is where now proper appraisal process comes in. We do not just give money because a certain segment needs that money. We have to look at what kind of activity we are going to do with this money. For example, my organization, we do what we call supervised lending model. And what we mean by supervised lending model is that first of all, we assess your project. We want to know that this project actually meets the threshold of the kind of money that you are borrowing. Once we do that, then we go to process the facility. And immediately the facility is processed, then we do what we call post-disbursement verifications to ensure that the money we give you has actually gotten into the purpose that you borrowed it for. Yes.
And you mentioned something about women, MSMEs, and even now, youth groups.
Yes.
When it comes to access to finance, what would you say are the challenges that they face when it comes to maybe even accessing this agricultural credit?
Oh, thank you. When you look at that category of borrowers, first of all, one of the major challenges is lack of conventional collateral. If you go to women, youth of this country, they don't own land. Most of the financiers want a collateral that can sufficiently secure their money. And therefore, if you do not have, for example, any conventional form of collateral like land, then you are excluded. You can't qualify for loan facilities. Then we ask ourselves, what are you supposed to do to alleviate this kind of challenge? Number one is now to try and move away from strictly collateral requirement to something like maybe use other forms of collateral. We have biological collaterals, and these are livestock. They can be insured, they can be used as a collateral. We have what we call movable chattels, the motor vehicles. Even the beef steers is themselves movable chattel. They can be used as collaterals. So we can also use what we call risk-based kind of appraisal. So if you move away from this kind of strict requirement, collateral requirement, then you can be able to address the issue of collateral requirement. Another thing that really affects this category is the transaction, the cash flow generated from what they do. You find that the cash flow generated, the transaction generated are quite low, and therefore they can't fetch a facility that actually they need maybe to invest or implement their own various projects. Another thing is collateral. I mean market volatility.
Yeah.
If you go to many smallholder farmers, if you go to many youth, women, PWDs, and even rural-based micro-enterprise, yes, they may produce their production, but when they don't have a structured, reliable market, then again, they are not able to service their facilities as required. They are not to optimally produce. They are not able to give their project a viable kind of production process. And therefore, these challenges, even another thing is lack of financial and management capacity. Many of these smallholder farmers, they lack knowledge. They lack that financial literacy to know that the money I'm borrowing, I'm not supposed to move it from my own private funds to repay. I mean, the project that we're implementing is supposed to sufficiently service the loan that I'm borrowing. So there's that lack of training and capacity building.
Yes. Lack of training and capacity building.
Yes.
What about even the knowledge of accessing agricultural credit? Is there information out there, really enough information regarding that? Yes,
definitely. You see, when you come to borrowing from our financial institutions, there's that kind of requirement that is required. For example, there is a viability of the project that is even coming up with a proposal itself. There is that list of requirements that they should understand what it entails. And even there's a process of what we call perfection of security. So if they are not able to know or they do not have that kind of knowledge, then that actually negatively impacts the accessibility of the credit facilities.
And you are within the agricultural finance landscape. But from where you stand, which are the most groups that maybe come for these credits, for these agricultural loans? Is it women? Is it young people, smallholder farmers, MSMEs? Which of those is more it comes for these things, loans?
Okay, it is a blended kind of absorption. We have women. We have a women portfolio in our organization. So that basically means that a woman comes, borrows, and they get money. We also have youth that have borrowed successfully and received money. We have MSMEs in our portfolio. The only thing that really affects that is the numbers. There's quite a low number of this category that have received this facility. But we are doing quite a lot to ensure that we increase the number of this underserved category. For example, we have a wholesale lending arrangement. We have partnered with eFund and the Government of Kenya under a project called Rural Kenya Financial Inclusion Facility, which is RK FinFA. And when you look at the setup or the kind of that project, the way it is set up, is that it has target. Like in the portfolio, you have 30% of financing should be men. 50%, 50% should be women, 30% should be youth, 5% should be persons living with disabilities, and the rest is supposed to be injected to rural-based micro enterprises. So we are trying to come up with ways on how then do we impact these underserved categories. We even have projects like the Enable Youth Project that is specifically targeted youth graduates. This project was brought to create decent employment for youth graduates in this country. And as AFC, we were able to serve about 300 million, and we really impacted on quite a number of youth of this country. The project was designed in such a way that the youth are taken into YABICs, that is youth incubation centers across the country. They are trained on various value chains. Those value chains are validated, and once validated, then they come for that facilities. And it had very concessional interest rate. One product had 0 interest rate, and the other one had 5% interest rate, which is quite concessional rate. Yes.
Let's look at some data here. And, when you compare demand and the money disbursed for these agricultural loans, there's a difference. For instance, the loan demand identified for 2019 to 2020, 2023, 24 was approximately 62 billion, but the disbursement over the same period was around 19.3 billion. Where's the disparity?
Okay. If you look at agricultural sector, it is considered quite risky. So many financial institutions have tried to avoid this kind of financing. And by that, we don't blame them. If you look at commercial banks, for example, they have what we call shareholders' expectations. And therefore, that money, the money that they use, is a deposit from their customers. So it has to be really taken care of. And also they have what we call regulator expectations. That's why you see if there's a default, then there are provisions. Those provisions eat into the profitability of financial institutions. So they try to be as strict as possible in terms of risk observation. And therefore, we don't blame them. So when it comes to DFIs, they are supposed to take care of that risk investment. And therefore, always demands as exceeded supply. For example, in our institution, we had a demand of 15 billion. And what you could observe was about 4 billion, meaning there was a difference of about 11 billion. When you talk of that 11 billion, it means the institution was not able to revolve the funding gap, the resource that it had was only limited to 4 billion. So that in itself is a factor. Then number two, when you talk of the demand that is there, it does not mean bankable or undisbursable demand. Some of the demand that you have, yes, it is there, but remember, most of the borrowers lack critical aspect. In this case, maybe cash flows are low, the collateral they have is not sufficient, they are not able to have that management capacity. For example, many may lack on-the-10 books of account, they may lack sufficient statement, they may not have that knowledge on how to run their project, and therefore all that limit the accessibility of that particular facility. Yes, so I think that is the explanation I can give in terms of that discrepancy.
How do we balance the need to, with loan recovery, portfolio quality and protection, maybe even of public funds?
Yes. When you talk of loan recoverability, and in fact that is a very important aspect of any financial. So when it comes to DFI, for example, Agricultural Finance Corporation, we were able to exceed for the first time, both disbursement and the collection, 5 billion. And therefore, when you disburse 5 billion, for example, and collect 5 billion, it shows your capability to recycle the capital you have. And therefore, what it means is that you are injecting quite a lot into the economy. So it is very important. And when you see you are collecting a certain amount, say you are disbursing 5 billion, collecting 5 billion, it means you are also taking care of public funds. And that is why I said we do what we call supervised lending model to ensure that the project that you intended to put up is actually implemented. Because without the project, then again, sustaining this kind of repayment would be extremely difficult. Yes.
And let's talk about national development, food security, and productivity and jobs. Because when it comes to agricultural credit, it matters because, as you know, production requires spending even months before you start building revenue or before revenue is realized. And, a farmer requires inputs for irrigation, machinery, livestock, and all that. But does credit really guarantee food security?
Thank you for that question. I would say yes. Remember, credit, when farmers borrow, they borrow to enhance their productivity. If you cannot enhance your productivity, then again we are saying you are not able or your project is not viable. That is why we come in, visit the project, and try to find out, is this project really viable? Does it, whatever you are borrowing, whatever amount you are borrowing capital, is it in line to the project you are implementing? You have to do all that. When you look in terms of, you mentioned something like food security. Say, for example, seasonal crops. I'm talking of wheat and I'm talking of maize. And remember, maize, unga, is one of the critical products that addresses the cost of living in this country. So you find out that we've come up with target product that target that particular segment, where we finance farmers and we expect them to make a bullet payment. If you are doing maize, we give you money to go and produce maize and then make repayment after 1 year. Then once you sell your product, you come repay and then you take it again. So it creates that food security. Number two, in terms of job creation, sometimes we go and establish, before we give the facility, how many employees does the farmer has? And once the project is implemented, then we also go to establish how many they have. Say, for example, if you hand 10 farmers and you come and find you have 15 now, it means you've handed more 5 people. Then there's the indirect farmers, those people that come on casual basis. For example, if you are harvesting, if you are doing maize production, of course you'll have to employ some people to come and till and prepare the land. You also have to employ some people to come spray and do all that. And also have the category that to come help in harvesting. That is job creation. And I can say we've done quite a substantial, we've employed indirectly and also directly quite a number of people of this country. Yes.
There's the shift towards wholesale and value chain financing. I would love that you talk about that. And are there metrics that even maybe anyone who wants to access agricultural credit, are there metrics they can use to judge whether now that approach is effective?
Allow me to start with anchor client model and what it means. Then I come back to wholesale lending. When you talk of anchor client model, this is where the institutions identifies a large-scale farmer, say an aggregator. For example, say steers fattening, who is able to aggregate livestock from various smallholder farmers and thereby creating their market. We also have large-scale vet shops where they give input on loan to their respective customers. And once those customers harvest, then they come and repay those facilities. We also have cooperatives. For example, say in rice value chains, where we have large cooperative that aggregate or collect the rice from smallholder rice farmers, and eventually once they process them, they are able to repay them. So that is the kind of anchor client model we are speaking about. So we have many of them, and what they do, these farmers, they are very important to us because, number one, they create market for these smallholder farmers. Imagine, Mike, if you have done production for over 3, 4, 5 months, and then you don't have somewhere to sell your product, it really disappoints the farmer. Imagine you have to pay school fees for your children. Like at time now, you don't have money, yet you have the product in your stores. It really discourages these farmers. And therefore, when we have this kind of farmers, we call anchor client, they create the market and they're able to pay on time, then that is creating a very strong market linkage for these smallholder farmers and also the underserved category. When it comes to wholesale lending, this is again where we use intermediaries. The corporation uses intermediaries like SACCOs, like microfinance institutions, microfinance banks, and even banks themselves to try and reach that particular underserved kind of borrower. We have smallholder farmers who may not have the collateral, yet the corporations need a collateral. So what do? We give money to SACCOs. These SACCOs have built strong relationships with these particular smallholder farmers. And when they have that kind of relationship, then they are able to lend because they understand them better. Even when we go ahead to negotiate the rate, the terms with these intermediaries, so that the benefit the intermediary gets from the corporation is transferred to the smallholder farmer. So we have that kind of arrangement, and actually we've partnered with the government. We've partnered with the government development partners to try and impact this kind of farmers. We also look beyond financing them. We go further to ensure that they are trained. So we have partnered with the various partners who go train these farmers, and they give us records of how many farmers they have trained. Also, we don't just sit down to wait the financial institutions, these financial institutions give facilities to any farmer. We have what we call monitoring process. So at every end of the quarter, we get the numbers. We also visit these farmers together with the financials the financials that we lend this money to. And we're able to establish that the money we give them has actually reached the category that deserved that kind of capital. Yes.
You know, agricultural sector is a wide sector and has various value chains. From a general perspective, when you look at, let's put it like this, say there is enough access to credit, which sectors which value chains within agriculture do you think would make the greatest impact in as far as growth and contribution to the economy is concerned?
Thank you for that question. If I look at the product that we have, I only say 24 in this order. One is livestock value chain, where we have various categories. Under value chains, we have dairy. Under value chain, we have poultry. Under value chain, we have pigs, piggery. Under value chain, we have shoot. We also put fisheries under these categories. Then we move to machinery and mechanization. And this is where we have those important machines that enhance the productivity of various agricultural enterprises. So we have, for example, milking machines. We have, for example, tractors. We have trucks. We have those kind of pickups and all that kind of machineries. They enhance mechanization, and therefore the production of various borrowers is enhanced. Then we also have agro-processing, and this is where we have the vet shops, where farmers go to buy input and all that. Then we have horticultural value chain. And the horticultural value chain, this is where we have the production of, say, for example, spinach, cabbages, those short-term crops that fall that mature within 3 months. Then we also have a sector we call floriculture, and this is flowers. And in fact, that sector, especially in our institution, is doing quite well, because it is generating a lot of foreign exchange for this country. We have farmers that are really exporting flowers. To the country. They are doing a very, very good job.
Especially to Europe, eh?
Yes, to Europe. We have many. We have many. And actually, let me tell you that we have financed one farmer that has really made us very happy. He has employed over 5,000 people. You can imagine. And horticulture. And they are doing quite a good job. We give them money and they pay on time. Then we have another category. This is the permanent crop. Here we speak of avocado, we speak of coffee, we speak of tea, which is actually also doing quite well. And we are happy with that sector. So in that kind of arrangement I've said, that is what I would have said, that needs a priority.
Yes. And you know, you mentioned livestock, and you know, livestock, we have pastoralist areas and even some places in the ASOL areas. When it comes to access to this, to agricultural credit, because that is part of agriculture, how are they faring when it comes to these things?
Thank you, Mike, for that question, because actually what we call them northern frontier counties. These are the counties within arid and semi-arid areas, as those counties. And one thing is that these counties are really suffered when it comes to the time of drought, because their livestock, some of them, they get wiped up by the drought.
By the drought, yes.
So it is a sector that we are very keen on. And actually, we've done quite a lot. We've invested a lot of money in this particular sector. For example, we observed a facility under Drive. Drive means the risking inclusion value chain enhancement for pastoral communities. And we've been able to invest about that is the money, about 300 million that we borrowed, and it was absorbed almost immediately. We have also a portfolio of that sector, which I think is also about 300 million. And the kind of challenges you've seen these people go is lack of market. And that is why I was speaking of anchor client model. So we have tried to address that issue by, number one, creating market linkages for them. That is engaging the large-scale farmers who are able to get the livestock now from the smallholders within the arrenders and arrend counties. They are able to pay them. And also we have arrangement with some of our clients where they're able to pick or to take up those livestock. They go, because they are able to drill water, to develop water collecting and water harvesting equipment in large scale. They have dams. So we try to find a way on how then can we discuss with these large scale farmers to take the livestock from smallholder farmers, come fatten for them, and then maybe at a small fee they are able to return back to the smallholder farmers, those livestock. Then we also have arrangement where we have financed these large scale farmers to even export these livestock to they buy, and then they are able to export to various countries. They are able to get paid, and then they pay the smallholder farmers as well as servicing our own loan portfolio. So it is a sector that we are very keen on, and we are also trying to engage the government. Currently, we are coming up with a kind of a proposal to the GOK so that we find out how then can these farmers be maybe supported in terms of concessional insurance policies. So we are discussing around that to ensure that in fullness of time, yes, then these smallholder farmers within those respective counties are not affected.
You know, when you mention agriculture, the first thing that comes to mind is farming. But, you know, when it comes to investments, some do not even consider agriculture as a worthy investment, regardless of whether there is access to credit or not. I'll take this as your closing remark. Is agriculture a worthy investment? And what do farmers need to do differently to access agricultural credit?
Thank you very much for that important question. I will say that agriculture is a worth investment. If you find the kind of portfolio that we have, as maybe Agricultural Finance Corporation, for example, where we have a portfolio of about 13.41 billion. If you look at the way it has grown, in the year 2020-2021, our portfolio stood at 8.3 billion. It has been able to grow up to 13.41 billion as at 30th in June 2026, which means there has been an improvement of about 5.1 billion across that particular period, which is 62% of the total growth. That tells you that this is a worth investment by itself. Mm-hmm. Number two, if you look at the kind of disbursement we are doing, 5.25 billion vis-a-vis collection of 5.31 billion in itself is enough demonstration that agriculture is worth investment. Then if you go around the country, if you visit some of our clients that we have, if you look at their success stories, they'll tell you that they have been in this institution for the longest. And therefore, if they are not investing then in agriculture, if you are not getting this facility to invest in agriculture, then again, you are not in the real good project. Mm-hmm. So I would say agriculture is worth investment.
It's worth the investment.
Yes.
Thank you so much, Christopher, for coming and just talking about matters of why access to agricultural credit is important. And we look forward to having you in subsequent programs in the future to just come and expound more on why this important issue is crucial to farmers within the country, because agriculture is the backbone of our economy. This is where this conversation ends, but I want us to cross over